Well, construction spending was on steady ground in 2023. The Commerce Department reporting a 0.4% rise in construction spending for November, following a 1.2% rise in October. Now, a lot of the resiliency is attributed to non-residential structures, according to the Census Bureau. Now, this came despite headwinds like higher interest rates, structural issues in commercial real estate, and the tightening in lending standards following regional banking failures. So, what can we expect going into 2024? We have Bernard Yaros, Oxford Economics lead US economist, joining us now. Thank you so much for joining me this morning. So I want to first start with what we see in terms of construction spending, something of a bellwether of how the overall economy tends to do. Break that down for us.
Right now, what we're seeing is that there's a lot of strength. It's very highly concentrated within private non-residential construction. It's not broad-based. And it's very much within manufacturing structures where we're seeing a lot of the strength. And even within manufacturing, this is not a widespread manufacturing boom. It's really just concentrated, heavily concentrated in computer, electronic, and electrical industries where you're seeing a lot of investment in structures right now. And this is really going counter to all those headwinds that you outlined at the very beginning of the segment. And this really has to do with recently passed legislation by Congress in 2022. So here we're talking about the CHIPS Act and the Inflation Reduction Act. So the CHIPS Act encourages investment in semiconductor fabrication through federal grants and tax credits. And the Inflation Reduction Act also similarly provides incentives for clean energy production and manufacturing. So what we're seeing is a lot of investments in structures in these industries that has really reflected the wave of capital investments that we've gone in semiconductor fabs and battery manufacturing. And even outside of manufacturing structures, we're starting to see a revival in power structures, especially outside of electric and outside of oil and gas. And this points to to a resurgence in wind and solar energy facilities, their construction. Also, you're seeing more transmission lines that are needed to bring renewable energy, to connect renewable energy to the existing grid. So we're also seeing some strength there. So a lot of this really, it's really been fiscal policy that has insulated some of this key area from a lot of these challenges, especially rising rates, tighter lending standards, and then just overall structural headwinds for certain areas of commercial real estate.
And Bernard, when you see this sort of growth really being reliant or because of being really propelled by fiscal policy, are there some risks that come with that? Perhaps if, we know that with these sort of buildings comes a lot of growth in GDP. Is there a danger, though, that it won't pay off?
So it's a lot of the spending. It's supporting growth in business investment and structures, which is not. It's not the end all be all for when it comes to growth. That's really to the consumer. But it's we still think that this has legs for this year. This isn't the economy hasn't been relying on this on this area for this for the resilient growth that we've gone over the past year. And I think there is. The risks are probably later down the road if we have a change in Congress and a change in the Oval Office where there could be some adjustments made to these tax credits. But for at least for this next year, I mean, there's a lot of reason to believe that this is still going to continue. These tax credits are not going anywhere. And when it comes to semiconductor, I mean, there's still that impetus among businesses to reshore the production of sensitive electronics, given the trauma we've all had with the supply chain issues during the pandemic. And then I would also say that generative AI, that's also a potential tailwind that could show up more fully this year, especially as manufacturers address the growing needs of the data center industry. So the risks are potentially for later on when you could have some changes in the political makeup. That there's a lot of question about the Inflation Reduction Act tax credits, but that's more of a question, I'd say, for the middle of the decade or later on in the decade, not so much for the outlook this year.
And as we look at potential bottlenecks when it comes to things like supply chains, we saw what happened with lumber prices, a lot of mismatched supply and demand there. But given the growth that we're expecting to see here, are there any supply chain issues that you're expecting here, especially when you think of semiconductors and sort of getting some of these products imported?
We're not. That's not our base case. But of course, there's all sorts of geopolitical risks that could create a lot of issues in the semiconductor supply chain, especially thinking about Taiwan. But for now, that's not our base case. And over the long term, I think these investments in semiconductor and fabrication here domestically should pay dividends for the nation's overall supply chain resiliency in these critical supply chains.
And of course, people are always asking about, residential prices as well. Looking at some reports we saw from Goldman, they're expecting mortgage rates to continue to tick down this year and next year. When do you think that's going to catch up in terms of supply and demand so that those who have been waiting on the sidelines are able to get into the market?
When it comes to, so also looking at this construction spending report, the residential side has been very strong, especially in the single family side, and that this comes as mortgage rates have fallen by more than 100 basis points, and this is since their peak in October, and this is unlocking some additional demand for new homes. And so we do expect that in this environment, home builders are going to be taking advantage of a frozen existing home market where homeowners are reluctant to sell. And they've been able to juice sales through mortgage rate buy downs and price cuts. And with inventory still very low in the existing home market, I mean, we continue to expect that the home builders will continue to grow their to continue building. And this is important for the economy, at least from a growth perspective, because we cannot rely on the multifamily side to support growth over this next year. It's really going to have to come down to single family, and that's just because we're at least in the apartment market, we're seeing loosening conditions with rising vacancies and weaker rental growth, and you've already got a historical backlog of multifamily projects. So there's not going to really be an incentive there for multifamily builders to really take on new projects. So the strong fundamentals that we see, especially with lower mortgage rates, still demand for new homes when you can't find an existing home for sale, right? It's very tough to find a for sale existing home. That's really going to at least provide support. It has through the end of last year, and it should through the beginning of this year.
We'll certainly keep an eye on that. Appreciate you joining me this morning. Bernard Yaros, Oxford Economics lead US economist. Thank you so much.